Joining us right now, a very special guest, Mahesh Nandurkar, joins us on the show right now. Mahesh, hi, good afternoon. How's the lockdown been treating you?
Hi, good afternoon. Lockdown is something that none of us has experienced, so probably once in a lifetime experience for all of us.
Yeah, it sure is. Tell us about that. You know, we never thought in our wildest dreams that we could telecast out of home, but here we are. But for the market, Mahesh, are things beginning to look up? Is the market now getting used to all the negative news? Because, I mean, the fact of the matter is, from the 7,500 levels, we've recovered almost 21, 25 odd percent. I mean, soon we're going to make it back to 9,500.
Yes, that's a pretty smart recovery from the bottom that we've seen. And my sense is that if you look at the global indicators, those are also looking up, not just in the form of some of the COVID data, which is coming out from the US and Europe, which is probably showing some early signs of peaking out. But also, if you look at the data coming in from the capital markets in the US, last 1 week has been a week where we see significant amount of corporate bond issuances. In fact, one of the record numbers that I've seen in the recent past. So the opening up of capital market for fresh issuance for corporate bond is actually a very, very positive sign in my view. But having said that, the other near-term negative that I wish to highlight is that seldom in history we have seen that markets fall in like one straight line and then start recovering from there. Usually there is a second round and a third round of sell-off as well. So I would be worried about that from a near-term perspective. But yes, if I take a 12-month view, I think this is one of the best times to start putting additional money into equities.
Okay, so you're not negating or not underruling the fact that there could be a retest of the March lows, or could it get even worse than that?
That is a possibility. So I'm not ruling that out because, as I said, if you look at the global financial crisis and then the European, then the taper tantrum and so on, and even prior to that, we haven't really seen in the past that we just see one low and then market just bounces off straight away from that. That has usually not happened. So my worry is that you could be moving into, one leg down. We don't know how far and how deep will that be, and whether we end up retesting the previous lows or the recent lows. That is a possibility which cannot be ruled out. But as I mentioned in the beginning, the broader economic data, the COVID-related data, and as I said, most importantly, the fact that we are seeing the credit spreads in the US are slowly narrowing. We've seen the oil prices improving from the bottom as well. Because mind you, while the low oil prices is a very good news for India, but extremely low prices is also not, because that actually creates negative investor sentiments globally. A lot of oil and gas companies have issued corporate paper internationally, then those begin to default, etc. So yeah, if you look at the international economic data and some of the recent capital market data, I am actually being more optimistic over a 12-month view.
Sure. The only thing, Mahesh, is, and we were chatting with one of the large mutual funds as well just a short while back. Retail flows have been a lot mature than they have been in the past, case in point being 2008. Now, I know we're in a bit of a special situation. Here, the cues are not from economics or markets, but from science, and God knows how this entire situation is going to evolve. But month to date, we've seen a provisional buy figure from the FIIs to the tune of about 1,200 to 1,500 odd crore rupees. But again, that's not looking like a very convincing figure. Do you think for the large, lumpy FPI, FII flows to come back with a vengeance, it will have to be a second round of stimulus that we will need from the PMO for that kind of money to pour back into equities?
Oh, absolutely. So I definitely believe that from the government side, two things were needed. One out of that has partially happened with the relaxation on the restrictions and the lockdown to a certain extent. Obviously, that has to be a gradual process, but I'm glad that we have seen the beginning of that. So that's point one. And point two is clearly there is a requirement for additional fiscal support, no doubt, because I feel that on a consolidated basis, we are already hitting close to about 8% of GDP for this year, even if there is no incremental fiscal stimulus, because the revenue, itself is going to fall short from the government perspective. But I would expect at least another couple of percentage points of additional fiscal stimulus to come through from the government, and I won't worry too much at this point in time, even if the fiscal deficit at a consolidated level goes up to 10% of GDP, because I think the need of the hour is to kind of support the livelihoods and support the corporate and the investor confidence, in my view. So I think that is clearly something that is needed. So I completely agree with you. A second round of a substantial fiscal package would be needed for the more institutional, whether foreign or domestic money to come in.
And if that were to come, considering, Mahesh, we've all debated about that almost every day, that it's a little late in the day that the government is going to announce whenever it does announce. We're still waiting for the second stimulus package, hopefully over the weekend. But what would it do then? Will it push the market into a different orbit and push it higher? Or at best, just put a floor and arrest the fall in the market from these levels?
Well, I think if you look at more fundamental, thing, if you look at what kind of GDP impact, what kind of corporate earnings impact that this COVID event is going to have, we are clearly seeing that the corporate earnings will need to be revised downwards by between 15 to 20%. And it's only fair that the market also takes that into account. So from the highs of 12,500 or so, which is where Nifty was before all this crisis started, I think it's only fair that market settles somewhere between 20-25% down, which is where we are right now. So right now, I would say things are looking more stable from the PE multiple and from the perspective of the corporate earnings revision on the downside. Now, what a package like the government stimulus, if that were to come, and I hope it comes sooner rather than later, it'll probably might actually get the investor sentiment on the positive side. Whether that ends up pushing the market further higher from here on, I think that will probably be more a function of what's happening or what will be happening globally. Because as of now, the Indian markets also is driven more by global events than by local events. So I think fiscal package will probably just support the sentiments. But whether it pushes the market up significantly from here, I don't think it's going to happen in a hurry, because as I said, there will probably be some leg down first before we start moving.
Sure. On the topic of earnings, Mahesh, what is the market pricing in right now? And what is the correct way of looking at earnings? Because, for instance, TCS in its commentary, while they managed to meet the street estimates, yes, March was a hit. Yes, there is a bit of, haze when it comes to visibility in large client orders going forward. But they seem pretty sure, and they've managed to put a timeline to it, saying that recovery will come by, and December 2020 is when they see things improving. If you just had to tactically take a call on when you actually see the earnings revival, which has again been long in the waiting, when do you see that really come by? Because for each industry, it's going to be, I guess, a different road to recovery.
Yes, clearly. So what I definitely believe is that the June quarter is going to be a big washout. I think some of the companies might even report losses in the June quarter because there could be as much as 40 to 50% decline on the revenue. September quarter will be somewhat better, and we will probably be getting into, say, like a flattish kind of a revenue and profitability at that point in time, in my view. And the reason why I'm saying this timeline, June quarter and September quarter, is that we have one example to go by as of now, which is China, right? They clearly have a 2-month head start from where we are. So, I mean, while we started our national lockdown from around 22nd, 23rd of March, China started that from the 23rd of January. And they started gradually lifting up from 8th and 10th of February, and we have now started to lift up slowly around 15th or 20th of April. And as things stand now in China, we are seeing almost 70% of the factory workers are back. All the restaurants and shops are open, and the utilization rates are running between 50 to 60%. And the expectation is that by the end of June, most of the Chinese economic activities would have returned to, say, around 90% utilization levels. So I'm just adding a couple of months and saying that probably around the end of August or September is where we will be getting into a break-even kind of a situation in India. And from the December quarter onwards, the YY growth should come back, in my view.
Sure. Mahesh, a lot of concerns are being raised about various and individual sectors. And I'm going to start with the financials and in particular with NBFCs and private banks. Because, in this world where the lead is being taken by the Fed in terms of forbearances and, for now, at least it's only 3 months here in India. God knows how long it's going to get stretched. A lot of concerns around delinquencies, especially when it comes to retail delinquencies and the rise in NPAs. Do you think those concerns are valid and justified? And if that were to be the case, do you now need to look at even some of the blue chip private banking names or blue chip NBFCs with a different sort of glass now?
I think we clearly need to look at the balance sheets and the cash flows and the ability of companies, not just in the banking sector but also in the other sectors as well. How long can they weather the storm? Because this is definitely a big storm which none of us had anticipated. So my view, therefore, is that as is the case going to be with many other segments, so will be the case in the financial and the NBFC space as well. There will clearly be a demarcation between the strong franchises with good balance sheet, ability to raise money, whether on the debt side or on the equity side, and then there will be the smaller companies, weaker franchises, and weaker balance sheet which will struggle. So my sense is that best way at this point in time is to look at the biggers, because I think the bigger companies will get even bigger in my view. So the large private sector banks, the large private sector NBFC on the mortgage, some of those names look pretty attractive. But I would, as of now, would not really be, going into smaller banks or smaller NBFCs, because we don't know, how much ugly this can possibly get. Also, you mentioned the point about the retail delinquencies. I think that is definitely a risk. We have seen the corporate NPL cycle over the last few years, last 4 or 5 years, in fact. And maybe there will be some more bad news, but I think the extent of that will be limited. But on the retail side, we haven't really seen any NPL cycle or any NPLs at all, in fact, if I can say that. So the possibility that there can be some negative surprise going forward is likely. So I would ideally avoid the financials with large retail and I would say unsecured retail exposure. I would be avoiding those names.
Mahesh, gets partially lifted come 20th, and the government at least, or the MHA, has given a clearance to some of the real estate projects and some of the other industries as well to actually lift the lockdown partially. Do you think that in this scenario there could be some beneficiaries out of that? I mean, there was some excitement on some of those cement as well as construction names. Are those spaces that one could relook at? And is it really going to be as easy for these sectors and companies to really spring back even if the lockdown gets lifted on 20th? Will they be able to resume work in a jiffy as on paper it seems to be?
Going into this COVID crisis, the real estate sector and the construction sector as it is was having their own issues. And what has happened right now has only compounded that problem. So once again, I will say that some of the large listed developers that can actually have the ability to deploy money, I think they will clearly be gaining market share. There is no doubt on that. So once again, I wouldn't really be taking a very strong sectoral calls here. But what I would say is that one can easily take a call that that one should be looking at more positively the bigger companies with stronger balance sheets. So the same will apply for the real estate sector as well, construction sector as well. So some of the larger ones, which are in the listed space, definitely have the capability to restart sooner rather than later. So I would definitely like that. If one has to take like sectoral calls, I would say some of the large private banks, as I said, appear very attractive. Some of the auto names look attractive. On the telecom side, it is looking like increasingly a two-player market, and some of the companies have ended up raising a reasonable amount of equity over the last 6 months. So they're clearly going to see the positive impact of strong balance sheet that they have been able to make over the last 6 months. But as I said, as a general principle, I would say that strong balance sheets and strong companies will become only stronger, and that is basic. So I will be drawing actually a horizontal line across sectors rather than drawing vertical lines.
Sure, makes sense. But when you say autos, within autos, where is it that you're bullish? And what makes you bullish? Because again, what we said about real estate and construction kind of stands true for even autos, because they too were grappling with the slowdown, hitting their volumes hard, and this entire BS6 transition as well.
Right. So BS6 transition impacts the two-wheelers more than the four-wheelers. So clearly, from a long-term perspective, I think four-wheeler makes more sense, according to me. And yes, the same kind of issues around unemployment and lower increase in salaries and wages, etc., is going to impact autos as well. But I think to a large extent, some of those numbers and some of that has been built in. And in fact, over the previous 12 to 18 months, the auto sector had done quite badly to start with. So, it's not that, it's a new problem. The sector has been going through this down cycle for a longer period of time. So I think they have seen, a lot of those negatives getting built into the stock prices and the earnings already. So I would say that some of the four-wheeler names, appear attractive at this point in time. And mind you, autos and telecom will be a couple of sectors that will benefit, I would say, from the post-COVID behavioral changes. The consumers will probably be looking at using their personal vehicles rather than public transport, and also the consumption of voice and data is going to be more, which should be a positive for telecom as well. So if you'll ask me, from a post-COVID behavioral changes perspective, autos and telecom should be the beneficiaries.
Yeah, that's a very interesting point that you made, and we were just chatting with R.C. Bhargav also just the other day, and he said the same point that it's kind of goodbye to shared mobility because everyone's going to feel safer traveling in their own vehicles. But besides autos as well as telecom, Mahesh, what are the other beneficiaries or pattern changes that you see in the post-COVID world?
I think from the pattern changes perspective, one thing is very obvious. The economy, is going to move more digitally, and more of the e-commerce is something that the buyers will be more comfortable buying. Unfortunately, in India, we don't really have any large listed plays, on the e-commerce as a theme. But undoubtedly, that is going to be, the case going forward and globally. And the early data from China also suggests that the consumers have adapted quite fast to buying and selling things on e-commerce platform than going to the physical store. So that is clearly going to be one. Secondly, I think the government expenditure pattern changes. Currently the spend that we have on healthcare as a percentage of GDP is among the lowest in the world. And I'm sure this is going to be a big wake-up call for the central, the state governments, and all kinds of agencies. And my sense is that there's going to be a substantial incremental expenditure that will happen, on the healthcare space going forward. Obviously, where that money comes out of is also going to be a big question. But from the positive benefit point of view, healthcare spending is definitely going to be on an increase. So the obvious beneficiaries will be some of the names on the pharma healthcare side, some of the kind of hospital companies, and I would say also some of the things that will benefit will be the companies involved in the construction and on the medical equipment side. Those will be kind of beneficiaries as well. Medical tourism can also substantially benefit because we have seen that as a trend in India over the last few years. And my sense is that the medical infrastructure in India will be substantially upgraded over the next few years and will raise the capacity for India to be a destination for medical tourism. So yes, there are few of these themes that will play out over the next few years. But from the stock market point of view, we don't really have any large listed plays that directly benefit from here. But I'm sure many of the companies will start looking at those businesses going forward.
Sure. In the post-COVID world, Mahesh, what role would central banks play? We've already heard, besides cutting rates just today, earlier in the day, the RBI coming with another set of measures to boost liquidity into the system and, of course, the quality for financials as well as SMEs and MSMEs. But do you think low rates would be the new normal? What kind of commentary can we hope to hear from the RBI going forward? Because it seems that the world post-COVID is going to toil for some more time to come. There is not going to be a meaningful recovery or normalization coming anytime soon.
True. So it's a very valid point, and it's actually a very global issue as well. So all over the world, and not just in India, the fiscal deficit as a percentage of GDP is going to rise, which means that the governments will be borrowing more and more, and they will be spending more and more as compared to what they were used to doing. And globally, this has clearly driven a big rise to what is called as a modern monetary theory, which basically means that the government's requirement to borrow will be so huge that it will be difficult for all of that to go through the market mechanism. And therefore, central bankers might be stepping in to provide that borrowing that is needed by the government directly to the government rather than through the market route. And which is what we call also as the monetization of fiscal deficit. Now, this is something that used to happen even in India back in the 1990s, and you will see that on an average between 1991 till 97, almost 25 to 30% of the fiscal deficit of the government of India was directly monetized by the RBI, and that is the possibility that is being talked about globally as well. In the Indian context, we haven't really seen any statement, on that front, either from the RBI or from the government side. But that is definitely, going to be a part of the debate. And I would say that, if we are going into a period where the ability of the private corporates and consumer to spend is going to be lower, and if the government has to step in a big, meaningful way, and if you're looking at the consolidated fiscal deficits going to be like 10% and more, of GDP, then there will definitely be some incremental support that will be needed from the central bankers. And in the recent commentary, the RBI governor has made a mention that they would be supporting the government in whatever kind of fiscal program that they may decide. And in fact, RBI has already taken a slightly unconventional route over the last two announcements. That they have, clearly, earmarked certain part of incremental liquidity, which they are offering to the banking system, to be utilized for purchase of corporate paper and, CPs. And in fact, today, the governor talked about, purchase of NBFC paper as well. So I think, we have seen that the RBI has shown its, ability to be unconventional yes, and there is clearly going to be probably more and more requirement for RBI and the other global central bankers to be more unconventional. The only risk that we have here is that these are the measures that one kind of looks at in uncertain times like these, and assuming that things begin to normalize, say in another 6 months or a year's time, some of these unconventional measures need to be rolled back as well. Because that's one big learning for us from the global financial crisis back in 2008 and 9, wherein while the fiscal deficit was raised significantly to support the economy, the same was not rolled back well in time. So that's the other risk that we need to keep in mind.
Mahesh, how concerned are you about the kind of fall that one is seeing in the rupee? Because I mean, traditionally one would say that yeah, that's great news for exporters on paper and buy those stocks. But I think in this kind of a scenario, nothing really holds.
That's true, and a lot of that is attributable to the global risk appetite. In times like these, the global investors are kind of pulling their money away from emerging market assets. So we are seeing, fall in the currency levels, not just in India, but in the other emerging markets as well. In fact, the LATAM countries have seen even bigger fall in their currencies. And my sense is that we will need to see some kind of stabilization in the global risk, appetite, which will probably take some time. But I would say that from the need of the hour is clearly to support the economic slowdown that we are currently going through. So the secondary impact on the fiscal deficit or rupee, I will probably say is like secondary. I wouldn't really say that fiscal response should be limited, keeping in view the impact that we've seen on the currency.
Thank you so much for taking the time out and speaking with us today. Stay safe, and we'll see you post the lockdown. Okay, that's the word on the markets and a whole host of other things from Mahesh Nandurkar. Quick snapshot of what the market is up to. Back to pretty much highs of the day, 92.67 on the index.